I'm John Generone, editor-in-chief of CorpGov. Thrilled to be back here at the New York Stock Exchange. I've got Kurt Wolf, who is the chief investment officer at Hestia Capital. There are two companies that trade right behind us we're going to talk about. Before that, though, I'd like to learn more about Kurt's background. So, Kurt, tell us about Hestia. What's your investment strategy?
Yeah. First of all, good morning to you, John, and thank you for having me on. To answer your question, as far as investment strategy, we're a deep value focused investment firm that has expertise in strategy and operations. And we leverage that expertise by targeting low multiple companies that A, have a competitive moat, and B, don't face operational issues with significant execution risk. We prioritize investing in quality businesses over diversification, so we tend to have a pretty concentrated portfolio. And as a result of that, we need a very targeted investor base. So we need investors that are sophisticated and are happy to have a concentrated portfolio or invest in a concentrated portfolio that's subject to short-term volatility in exchange for the long-term results that we can get. And so over the past 15 years, we've done an excellent job of building a very sticky, very stable investor base that's anchored by founder capital.
Great. So let's talk about GameStop. I mean, I was just telling you in the green room here, you were involved in this company before it became the biggest story in financial news. You're the first activist involved. Just tell us about how that came about. How did you find it before all the Reddit guys did?
Yeah, absolutely. Yeah, I appreciate the question. And we actually invested in GameStop twice, once in the early 2010s, another time in 2019, ahead of the meme stock craze. And the rationale both times was the same thing. One, we thought there was a significant moat around their used gaming business that was predicated on the physical media. So their used business is only a value if physical media is important. And I think that the institutional investor base underappreciated the importance of physical media to GameStop's core customers. So when we invested, it was really based on what we believe to be a misunderstanding of the longevity of physical media in the console ecosystem, which underpinned the value of the business.
I got you. So what's interesting is that you were an activist and you also had a seat on the board of directors. Tell us how that was.
Yeah, it was a great experience. I think it was great for me personally, for our investors, and hopefully for shareholders and everybody and all stakeholders involved. So first off, I'd say our investment style is we do get very in depth into the investments that we make. So we have an excellent level of knowledge of these companies. So joining the board, it was very easy in terms of I knew the company very well, knew the issues it faced. And then also, given that Hestia was so heavily invested in GameStop, it was appropriate both as a fiduciary to the fund and a fiduciary to shareholders for me to be highly involved. And as everybody would agree at that point, the company had a lot of troubles. And when a company faces troubles like that, it's really important that you have active board members who can put a lot of time in, that really know the business and understand the challenges. And I think that lined up really well.
Man, there's so many fun questions. Let's talk about short interest at GameStop.
Yeah.
Boy wonder Gabe Plotkin got destroyed by that. Right. How much attention did you pay to short interest, as an investor in GameStop?
So I would say we're a fundamental-based investor, so we didn't really think a whole lot about it in our investment. Obviously, it creates upside potential for the stock, but we're very fundamentals-based. But when it did get to the point of activism, where we felt like a shareholder needed to step in to push through changes, it factored in pretty large. We aren't an activist firm. We're not a household name. So we felt like we had a very clear agenda, great board members. We thought we had facts on our side. But there was a level of concern that people may not be comfortable supporting somebody who hadn't done this before. So the heavy short interest really pushed the investor base that would be voting toward people that were more open to boardroom change, and that kind of quelled our fears about maybe not being so well known in the activist space.
Great. All right, let's shift to another company also trading right here, Pitney Bowes, PBI. Tell us about how you came across that company. I'm actually familiar with it too. We discussed this the other day.
Yeah.
It's a company that's got a long history, right?
Yes.
And yet maybe hasn't moved into the 21st century in some ways. Explain that.
Yeah, no, absolutely, yes. So Pitney Bowes, as you say, it's a company that's been around for 100 years, and it has an incredible history. It's an iconic American firm. It has an employee base that's absolutely fantastic. They are committed to the company in a way that's rare to see. I grew up very blue collar, and labor company relations come up and can be quite a thing, but it's impressive to see that relationship. But specific to Pitney Bowes, what really attracted us was the same thing that attracted us to GameStop, the same thing that attracts us to pretty much any investment. So first off, we saw once fixed, for lack of a better word, the company traded a ridiculously low multiple of cash flow. So that was incredibly attractive. The second piece was the business has a competitive moat. There's a reason it's been around for 100 years. People expect the business to go away, but it's not going away anytime soon. And to that point, we had looked at the company 20 years ago and thought it was going away in the next 5 years. It's going to endure. So first, valuation. Second, there's a significant moat around it. And third, maybe counterintuitively, there was a lot of operational opportunity at the company, a lot of problems. And this is where sort of our strategy and operations background came in. And so I'll key in on 4 real opportunities we saw. First off, there's a business they were in called global e-commerce. They were losing more money in the business every year. It wasn't working. So one of the things that needed to happen is they needed to either quickly fix the business or get rid of it. And ultimately we did get rid of it. Second, there was a tremendous opportunity for operational improvement, cost out, which would lead to profit improvement. Third, the balance sheet was not well managed. So there was a great opportunity to massage the balance sheet, free up cash, which actually would improve profitability of the business, not in addition to freeing up the cash. And that cash, of course, could be used to pay down debt, invest in the future of the company, or return to shareholders.
Yeah.
And then the fourth piece of that was it's unconscionable for a company of this quality to have the cost of debt that we do. So there's an opportunity to pay down debt, and not just that. As we execute on the first 3 pieces, I anticipate that the cost of borrowing will go down significantly for the company. And fortunately, all 4 of those are easy to execute on, and I think that we're moving with all haste to make that happen at Pitney Bowes.
Great. Now, folks, we're going to talk about proxy advisors. For those of you who are not familiar, these are agencies that give recommendations when there is a contested board. And oftentimes, Kurt can dig into this more with me, a lot of investors don't have time to make these decisions themselves. They take those recommendations very seriously, right, Kurt? So yeah. Glass Lewis and ISS, how do you approach those guys? How do you make your case with them?
Absolutely, I appreciate the question, and you're right. You play a pivotal role in the situation for just the reasons you laid out. So as far as approach to them, in the end, our job is to put forth the best case possible for change at the company and clearly articulate why what we're proposing will be good for the company. So that's first. Second, it's really important to identify candidates that align with what needs to be done at the company so that you can execute on the plan that you've laid out. And I like to think we did a very good job in both. I'm incredibly grateful to high quality directors we were able to get and the amount of time they've put in. And then specific to the advisors and even other shareholders, a critical component is just their engagement and involvement. You can make the best case in the world, you can have the best director candidates in the world, but if they're not actively engaged, it's really hard to kind of get your message through. And that's what was really rewarding in this process. I was very happy with the level of engagement from the proxy advisory firms and from my fellow shareholders. And of course, we didn't get all shareholders to vote for us, but we respect their opinion. Smart people with good intentions can have very different perspectives on what's best for the company. And after joining the board, to that point, there were people who necessarily didn't vote for us. We were disappointed, but once joining the board, it became important that you represent all shareholders. So we did make a significant effort to understand why were there shareholders that didn't align with us, and what are they looking for out of the company.
I got you. So I just thought of a question, going a little off script here, indulge me. Can activists be too big? So if you're Dan Lowe, Bill Ackman, you're going after these $50, $100 billion companies, they've got 40 analysts. Is there more opportunity for a guy like you who's focused on these guys that are not micro cap, but they're smaller?
I think that's absolutely the case, and I would just say not just activism, but investing in general. We are a small fund. We want to stay a small fund. It's one of the reasons that a lot of the capital is our own capital, and the reason being, Dan Loeb has a much harder job investing in and trying to push through change at larger companies. The reality is, and not to put myself in an unfavorable light, I don't have to be as good to generate Dan Loeb type returns in a smaller space, and it's easier to be successful at activism because it's just not as the companies are less sophisticated, so there's more problems to be fixed, and it's easier in a proxy fight to kind of identify those problems and also identify real opportunities.
That's a great explanation, Kurt. Now tell me, as a director or an activist, now these are intertwined, which of those two gives you more ability to affect change at the company?
For us, absolutely, as a director. Specific to the case of Pitney Bowes, our experience is we're not an activist firm. So Generally, we speak to management teams when we have an investment thesis in a company, and invariably we find in most cases the management team is smarter than we are and they're closer to the situation than we are, so we're always a happy investor. And in certain occasions, you feel there's a sense of disagreement. Unfortunately, in the case of Pitney Bowes, there was a different perspective and there was just no progress being made in conversation. And that unfortunately is what led to the proxy fight, which in all honesty, we prefer to avoid. But since becoming a director, in that first year, I think we started to make some progress and pushing forth our agenda that would create value for the company, and things really got accelerated in the most recent refresh of the board. So since May of this year, the company has adopted essentially the plan that Hestia laid out over a year ago for the company, and we've been moving against that plan with incredible speed. And I can't tell you how exciting that is to say. The stock has performed well, and I think there's some sense of optimism, but I think even the most optimistic shareholder is going to be really pleased to see what the true potential of this company is, because I don't think many people appreciate just how great this business is and what kind of cash flow it can generate for shareholders. So there's a lot of good news ahead. Sorry.
Well, no. But by the way, Kurt's being a little modest. The stock's up 100% this year. So
okay.
well done, Kurt. All right, just a couple more questions.
Hopefully a lot more to go.
Yeah.
But yes.
So what, are valuations high? Are they low? You see any targets out here? Some hunting ground?
In our opinion, we think the market's pretty overvalued, and there's a whole host of reasons for that. The one that I guess I would really hone in on is the Federal Reserve, and maybe it's an easy target, but the reality is, in the way that we think about it at a simplistic level, is the Fed is essentially become an investor in the asset community. They have always been, but they haven't really changed their amount of investment. Their balance sheet's been stable, but they've created $6 trillion that they've invested into asset markets. With complete price insensitivity. So anytime somebody shows up in a market and doesn't care about price, it's going to drive price up. And I think, $6 trillion is a lot of money, but I think the true problem isn't just the $6 trillion. The true problem in our eyes is that the Fed has shown a repeated willingness over the last 15 years at the slightest hiccup in the economy or in the markets to jump in and print more money and get more involved in the markets to drive asset prices up. So, and we think that can potentially persist for quite some time. So it does create a difficult investing market for many of us.
All right, Kurt, last question. What's next for Hestia? Valuations are high. Can you still make some magic happen? What are you thinking?
Yeah, no, absolutely. In the short term, we're 100% focused on Pitney Bowes. You talked about the stock being up 100%. My goal, ambition, and I think what's very reasonable is significantly beyond that. And I just want to make sure that we deliver as flawlessly as we can on the plan that we have ahead of us, and I believe we will. As far as what's next, after once we have success at Pitney Bowes and get things where they need to be, we'll go back to the boring business of looking through out of favor, unloved companies and trying to find that true diamond in the rough. And the one thing that's nice, tying back to your previous question about these types of companies, and it's true of Pitney Bowes as well. So a company like Pitney Bowes, we tend to invest in these idiosyncratic situations where their price is really driven by the performance of the company and it's almost uncorrelated with the market over a prolonged period of time. So in other words, we feel really good being invested in Pitney Bowes and some of these other types of investments, because even if the market crashes, what's going to drive Pitney Bowes' valuation is if we deliver on plan, earnings will be there and people will appreciate it no matter where the market goes.
That makes a lot of sense. Well, Kurt, let's leave it there.
Perfect.
This has been Kurt Wolf, who is the Chief Investment Officer at Hestia Capital Management. I'm John Generone, Editor-in-Chief at CorpGov, signing off from the New York Stock Exchange.